All right, guys, welcome back to another video. My name is Daniel with Leon Investments, where we offer consulting to those who want to invest in the stock markets or trade in the stock markets. If you're interested in any paid services such as consulting, feel free to check the link in the description where you'll find a scheduling link through Google, where you can schedule a free complimentary call to see if we're a good fit. Or if you'd like to join our Discord community, which is free, and learn how to trade there and be part of a trading community, you can go ahead and do so. Today, what I want to talk about are some biblical principles for stock market investing. And I believe the Bible has some wisdom on how to grow wealth over time. And I compiled a list of verses or Bible verses that support such ideas based off of what the Bible says. And so if you're probably here, you may be Christian, you may be a Christian, right? You may believe in God. So I believe this video may have found you for the right reasons. So let's get right into it. The number one reference of the Bible is the parable of the talents. Now, this is very important because although this parable, you can apply it to many situations, it really relates to managing money. And especially if you are some sort of manager, right? Like a manager or steward for others, which in my case, that's kind of what it is. But let me go ahead and, read some of the bullet points that I noted here based off of this parable. It could be found in Matthew chapter 25, verse 14 to 30. And the first bullet point is God rewards good stewardship. So by being a good steward, you will be rewarded. Prudent steward, you would be rewarded. The importance of not burying our resources. So as you probably know, you don't put your money under the mattress, in a couch or whatever, because or not do anything with it because it's going to go down in value due to inflation. You have to put that money to work, put those resources to work, because if you're not growing, you are diminishing. So that's just very important. You can at least put it in a savings account and earn interest. So, if you're not familiar with the parable of the talents, I can explain to you exactly what it is. So I believe there was this master, right? And he gave some talents, which is what money was called back then, to three servants. He wanted them, I guess, to grow that, to see what they do with it, right? So one of them went and buried it. The other one grew it, and then the other one, he grew it in the sense, I don't know, they two of them grew the money, right? I'm not an expert in the Bible, so please, I guess, criticize me for this, but I kind of have the right idea. And then the third guy, he didn't do anything. He just buried it because he was fearful of losing it. So the master was quite disappointed in him and gave him a couple of slaps, I think. He told him he could have at least put it in a savings account and earned at least some interest. So that basically, and then for the other two, I think the master increased their funds so that they can manage more. So how does this relate? Well, like for example, if you're like a portfolio manager, you are entrusted with resources by your clients, and you are entrusted to grow those resources over a period of time by your clients. And so what do you do exactly? You don't bury it, right? You don't bury it and not do anything with it, because it's not going to satisfy your clients. You are literally entrusted with the few, and then you would be given much more. I believe that's another Bible verse. So if you are able to grow your funds or your clients' funds over a period of time, you're going to be entrusted with more and you'll grow. I believe Charlie Munger mentioned something about working with what you have, right? And then more will come, right? And that's usually what happens, because if you're working with what you have, whether it's 100,000, 200,000, 50,000, a million, whatever it is, those clients are going to refer you to other clients, or they're going to increase the AUM with you, as you generate positive results. So focus on doing on the work that you have on hand, rather than trying to go out and get some more clients or anything, because it'll all fall into place. The work on hand is grow the investment. And that's just very important. And I think that relates to me a lot, because that's essentially what I do. I manage portfolios for select clients, and that's essentially what's happening. They're referring me to other clients and increasing their AUM with me after seeing positive results. So this parable is definitely manifesting into a real world example. In my case, that's the case. So there's also a wisdom in planning. So this is mentioned in Proverbs chapter 21, verse 5. The plans of the diligent lead to profit. So when you're trading, you really have to plan out your trade. You just can't, allocate capital and just like, okay, let's see what happens. Because at that point, you're gambling, right? Especially if you're allocating a large percent of your portfolio in one entry. A trade is not just one entry, it's a series of entries that are done to increase probability of profit and increase potential profit while mitigating risk. That comes with preservation of capital and also allocation. Yeah, and you also have to allocate capital, which presents a conflict of interest. How can you allocate capital without being greedy? How can you allocate capital and how can you preserve capital without being fearful? Because the reason why you preserve capital is for worst case scenario, and usually you could overstep. You can be extreme with preservation of capital because you're fearful. You don't want to allocate capital. You want to put your capital at risk. So it's balance between the two. And I think I mentioned in one of my other videos, life is just about balance in all areas. In all areas, and it's essentially finding that sweet spot. That's why I say that trading translates, if you're successful in trading, you're probably successful in life because most of the principles in trading apply to real world life scenarios. So you have to plan exactly what you're going to do on a trade. You just can't wing it, and expect consistent positive results over time. So wisdom and planning, that's mentioned in Proverbs chapter 21, verse 5. Connection to investment research and analysis. You have to do your research and you have to do your analysis. You have to educate yourself on technical analysis, fundamental analysis, and also understand what is happening with that company, what the narrative is, what the news outlets are pushing. What is the narrative? Is it negative? Is it positive? If it is negative, what is the stock price doing? Is it decreasing? Is the market overreacting to to this news? If it is, do you think it's a buying opportunity? What type of stock is it? What's the company? All of this plays the equation of risk management. What is the price of the stock? What is the size of your portfolio? How much capital are you going to allocate? What is the cost if you're trading options? What is the premium on the option that you're choosing? What is the expiration? So many variables that need to be considered that is only done by planning. You plan and you make it make sense so that when you explain it to a baby, they understand it. Because at its core, trading is very simple, but a lot of people misunderstand it because they don't see how it works, I guess, and they really intertwine their emotions with it. When we're dealing with numbers, it's very emotionless, but we also are dealing with people at the end of the screen. So that's kind of where the psychological aspect comes into play. So it's like, how can I gain an advantage over these discrepancies in the market, over these other people that are overreacting to something that may not negatively affect the company's fundamentals over a long period of time, and there's still going to be some demand for their shares, right, which will drive price up, because there's also a distinction between what the stock price does and how the company is doing fundamentally. They're not directly related, although many people do think they're directly related. They think, oh, the company's doing well, let me invest in it. But let me give you an example. If no one buys a stock, do you think it's going to go up even though the company's doing well? It's not. So indirectly related. Connection to investment research and analysis is very important. Importance of patient, methodical approach. You have to be patient. Time in the market over timing the market. This is mentioned by many people that are successful in investing. They spent time in the market with proper risk management, proper planning, versus trying to time the market. Trying to time the market is not, there's no successful risk management strategy with timing the market over a long period of time. If that was the case, I would invest 100% of my portfolio every single time in one entry. It's not like that. You don't do it like that, because if you're able to time the market, you're basically saying, I'm able to predict what's happening in the future. And if you have that recipe, I'd like to know. Trading and investing isn't what you see on social media of these people filming themselves making $20,000 on a trade in that one setting, because there has to be a specified amount of time that has to elapse for that trade to play out. And when that trade is in the green, you're not turning on the camera to record. You're collecting your profit. You really don't know when it's going to happen. It's not sure it could happen pre-market. You turn on your camera and you're like, okay, look here, boom. All right, it's fine. But like consistently over time, just keep doing that. It's a little, headache and a half, if you ask me. Oh, you're collecting your profit. Maybe you could do a trade recap after, but those people that you see, they're basically timing the market. Now, I'm not someone to say that their method is wrong or it's not working, because I don't implement those methods and I am not in their shoes. I'm not saying that they are, fake or whatever. I'm just simply saying that it's hard. It's hard to time the market every single time. Might as well invest 100% of your portfolio if you have that edge of knowing when the market's going to turn, which you don't. So it's like, how do you come out on top? Well, over time with proper risk management, which comes from planning, which is what we discussed on Proverbs chapter 21, verse 5. Importance of patient methodical approach. We already went over that. Diversification. Diversification is kind of interesting, because Warren Buffett says diversification is, for people who don't understand. It's for, I don't know his exact verse, but he doesn't really support diversification in that one verse, but diversification is needed. Like, you need diversification. Now, there's different ways. This is, again, going back to balance. So you need diversification, but you don't need extreme diversification. It's how you manage that diversification based off of new data that comes in the stock market. It's always changing. You may decide something today, but tomorrow it changes completely because you have more information. It's like that game where you have three doors, a game show host, and a player. And the game show host tells the player to choose one of the doors, where in one of the doors, there will be a brand new car or something like that. And then behind two other doors, there's like a goat. And you choose a door. And before he reveals that door, he shows you another door. He shows you what's behind one door. And he's like, this is not the one. Would you like to change your answer? And a lot of people will not change their answer because of fear of, the game show host is just trying to make me switch, so I wouldn't choose a car, so they don't change their answer. But on a statistical perspective, where probabilities are in play, it's always best to switch your doors, because he increased your probability of success by switching your selection. Now you have 50-50, well, not 50-50. I think it just increases. I don't know the exact numbers, but your probability increases by switching your door. And that's making an additional bet in the stock market. That translates to saying, okay, I'm going to make an additional bet. Maybe it wasn't this level that the price increased, but I'm going to make an additional bet, right? Risk management, increasing your probability. You can't just stand still out of fear, because you're not increasing your probability of profit anymore. Just like in the example of the game show host, if I stay on the same door, we're not increasing my probability of profit. We're just wishing and hoping. Diversification, going back to topic, diversification is something that you build over time. You don't simply, I have $1 million spread out amongst 10 different picks. You build that diversification over time, but you don't want to over diversify because you're spreading yourself too thin. You want to really have that cash on hand to adjust positions, to adjust your positions, your existing positions, taking on additional bets, switching your doors. Going back to that example that I mentioned, this is key. And so, yes, diversification is important, done properly, balanced well, and you should be able to come out on top. And of course, like I said, the risk all ties down to the type of stock, what's the company, the price of a stock, your portfolio size. You got to take a look at all areas. This is something that I don't see being covered on many videos. They're just like, I don't know, profit, sign up to my course or something. I don't know. Anyways, this is something that needs to be considered, and it's at a deeper level of understanding, not just what's on the surface. You know what I mean? Diversification, that's mentioned in Ecclesiastes chapter 11, verse 2. Invest in 7 ventures, 7 companies, 7 different positions, or yes in 8. Invest in 7 ventures, yes in 8. Diversification is highlighted. The importance of diversification is highlighted in this Bible verse. So yes, it is important, but finding the balance between diversification is equally as important. You can't diversify yourself too thin. You can't be at any extremes. Highly concentrated and highly diversified is wrong. You want to be in the sweet spot, in the middle. And that's something that you build over time based off of new data that comes in the market, which is price change, news articles, these types of things. You have to take into consideration these types of things, because that's going to eventually change on how you diversify, on how you build the portfolio. Very important. And it's in alignment with modern portfolio theory. This Bible verse is in alignment with modern portfolio theory. And then it's also risk management through diversification. You manage risk through diversification, which again is what I mentioned before. It's in line with how you manage risk and how you diversify. It's how you find the balance in between both. Practical investing principles, research and due diligence. You have to do your research and you have to do your due diligence. You can't just throw, I don't know what's the saying, something on the wall and expect it to stick. You need to really do your due diligence and your research behind why you think you have the edge in this trade. For example, one of my trades which was a trade on Google stock was decreasing in price because they were announcing that they had a lawsuit that the DOJ of monopolizing search or something like that, and they wanted them to sell a Google Chrome so that they don't monopolize search. And so the stock price started going down. I mean, like, really, we're talking about a conglomerate like Google, who has a huge moat, and you think they're gonna really sell Chrome and the stock price is falling? Give me all the shares I can get at that price. Now, of course, without being overly greedy, right? You're not going to just invest 100% of your portfolio because you're going to go. You have conviction on the trade, and you're calling out the BS in this news article, and how the price is reflecting due to that news that came out. You're not going to do that. Of course, methodical approach and planning. And so with that trade, that's a trade that I did my research and my due diligence, and I came out on top as new data started to unfold, as new prices started being printed on the chart. It started adding to my conviction, in which I decided every time I saw a new chart in price action on the chart, hold, and I added slightly without being too greedy. Without being greedy, I added slightly as that conviction built. And what happened? They released a news article about Google making this quantum computing chip. Of course, not available to the masses yet, but a very significant advancement in current technology. And that stock really did go up, which added, now the narrative is changing. The narrative changing from negative sentiment to a positive sentiment, and the stock price is reflecting that. Now, is that the end all be all to Google stock? No. The narrative is changing, and it may continue to support a further uptrend in stock price. We don't know. We have to see what the narrative is as the news starts coming out and manage risk accordingly. So you have to calculate the cost, right? Luke 4, chapter 14, verse 28. You have to calculate the cost of what your trade is going to cost you. If in the worst case, X situation happens, and be okay with that. Because if you calculate the cost, if you premeditate your trade, you're going to be okay with certain scenarios. You just have to think about it logically and exclude emotions out of it. You're probably going to say, oh, this is a ton of money. Oh, I'm down a ton of money. You got to look at percentages. In the stock market, it's all about percentages. It's not about the dollar amount. As long as you're managing risk accordingly, which is done by looking at the percentage of your allocation in certain stocks based off of what the price is doing, you're going to look at it from a different perspective, not just, oh, the dollar amount. Yes, it is a lot of money, but you have to separate yourself from the money, from how you value money, of how you see money. Because this is pretty much a glitch in the economy, a glitch in the system, the stock market. You have all of the money in the market. You just got to pull it out of the banana stand. You know what I mean? How do you pull it out of the banana stand? Well, we're not fortune tellers. We're not genies. We can't tell the future. So we got to implement proper risk management. Calculate the cost. How much capital are you willing to allocate in the position with X amount of, with certain situations that happen in the market? See how you can benefit off of it. Because every market participant is looking to generate a profit. That's the outcome that they're desiring, a profit in the market. So you kind of have to be a bit contrarian, right? To be able to generate, you can't implement proper risk management being another person that follows the herd. You just can't. It doesn't work. It does not work like that. So there's a tip. Understanding company fundamentals. You have to understand the company fundamentals because you need to know if you're buying the shares at a good price. There's a difference between value and price. Price is what you pay. Value is what you get. Warren Buffett said it. Value is what you get. Price is what you pay. I'm paying $20 per share for a stock. Okay, that's the price. But the value, is it undervalued or overvalued? I want to pay for things that are undervalued, that the market is mispricing, right? So that there's that discrepancy in value and price, right? So that when that price eventually goes back to its intrinsic value or its fair value, I'm able to pull some profit out of the market. And that's done by taking a contrarian approach. Many successful investors support a contrarian approach because that's how you implement proper risk management. You can't implement proper risk management if everyone's pushing the stock price up, meaning everyone's bullish on the stock, and you're doing the same. Yeah, sure. You can balance that out with something else, like another position in the portfolio. But really, taking a contrarian approach is key to proper risk management. Standing company fundamental. We already went over that. Industry analysis. You need to analyze the industry. How is the industry expected to grow over X amount of time? At what rate? Are they having a lot of capital expenditures? Right now, there's a lot of capital expenditures being there's a lot of capital being invested in AI, Amazon, Meta, Google, and investors aren't really liking that because they don't know how that's going to affect earnings per share. And so there's not a lot of certainty. But with that uncertainty comes volatility and opportunity for profit. So that's where patience comes in and proper logical methodical approaches are rewarded. And that's when you deploy, technical analysis basics. You have to know what the chart is telling you. You need to have some sort of understanding on a technical perspective, because if you don't know what the market's doing. You don't know what the market's thinking. You don't know, because price action is only an effect of the actions that people and institutions and algorithms are taking on the stock. We simply react to the changes that are happening in the market. We simply react. We can't predict the future. So what do? We just simply react. We can't do anything about it. We react to it. It's how we react to certain situations, both in trading and in life, that allow us to to get ahead in the future, which is profit in the market and also advancement in life to whatever your goal is. You need to understand technical analysis. That's an important part of trading. With technical analysis alone, I think you can get the edge in the market. But adding fundamental analysis, which is very important as well. I mean, it's just an added piece of the arsenal, so might as well. So fundamental and technical analysis are very important as well. Risk management is number 2 here under practical investing principles. The prudent sees danger and hides himself. So Proverbs 22:3. So this ties down to position sizing, stop loss strategies, and portfolio allocation. Now, one thing in the market, you really have to know how to be a good loser. Because if you don't know how to be a good loser, you could lose 100% of your portfolio just like that, 100%. But you also have to match it with or balance it with position sizing and know when to stop sizing on that position and know when to cut your losses. And this is where diversification comes into play, because if you're too concentrated on one, you could easily get wiped out. If you're too diversified, you're not going to have enough cash to allocate to existing positions. So it's balance between the two. This is mentioned, the prudent sees danger and hides himself. This is mentioned in Proverbs chapter 2, verse 3. And then you also have portfolio allocation, which is kind of what I mentioned before. If you diversify too much, you're not going to have cash to allocate in different positions when the opportunity presents it. So while one position may be down, which you're going to have positions that are down, that's inevitable. I don't remember, I think Ben, what's his name? One of these... I think his fund is Pershing Square. I don't remember his name exactly. I don't really follow him. But he said that he doesn't know of a single portfolio manager that doesn't have existing positions that are down. So it's knowing when to stop allocating capital into a position and also knowing when to continue allocating capital into a position while also diversifying, because other stocks are going to go up in your portfolio. So that's going to allow you to have more cash when you do realize that gain, to maybe allocate on positions that have been really beaten down, where there's a discrepancy with price and value. Makes sense to allocate capital into that position. All of this ties down to success in the stock market. It's things that you have to understand, and I think the Bible really provides that wisdom. So that's kind of why I'm going over it. Risk management, portfolio allocation. We already went over that. Long-term perspective. Wealth gained hastily will dwindle. Proverbs chapter 13, verse 11. So again, day trading, 100% stay away from day trading. Now, is that to say that people don't find success in day trading? I think I think there's a fraction of people that find success in day trading. Of course, I don't do it, back to what I said before, so I'm not in their position or in their shoes to kind of know if they are BSing or if they are actually successful. So a ton of wealthy investors and hedge fund managers and portfolio managers don't day trade. They swing trade or they invest for the long term. They just continue holding their position. But you're going to have to eventually realize your gains at one point, you know? It really depends on the type of investing you're doing. Like if you're doing investing to actually gain control and be on the board of directors for the company, I mean, that's a different type of investing, which is kind of more private equity where there's hostile takeovers going on and they change the management of the company and they fix it up and then they sell it for a higher price. I mean, that's a deeper level to, I guess, invest. Again, time in the market over timing the market. Mentioned here in Proverbs 13, verse 11, time in the market will always beat timing the market. Always. Even Warren Buffett has supported that idea of if you just waited long enough, you'd be up on your position. Sure. Is that return a good return for the amount of time that you spent in the market? Probably, maybe not. That's a different story. But the fact that you made some money, I mean, it's a win on its own, you know? So it's also understanding when to allocate capital so that trade, that investment really does make sense for the time that you were in that trade. And that comes with technical analysis. That understanding comes with technical analysis and fundamental analysis and understanding what you are buying and why you are buying it. Value of compound interest, compounding those returns over time, realizing gains and reinvesting will put those gains to work. Definitely that's something that should be understood. Ties down again to time in the market versus timing the market. Avoiding get rich quick schemes. This is something that people struggle, especially because they see trading online and they think that, oh, this is how I'm going to get rich from one day to the next, and they take these high risk, low probability trades. And if you are that type of person, maybe you want to reach out to me because you may have the capital, but maybe you're not sure exactly how to manage it, and you're taking these high risk trades with low probability of success, and might as well gain the information first, right? And then make the investment in attaining the information, and then making the investment into securities, into investing. Because again, you don't want to be, going into war without a rifle. You know what I mean? Unless you are that guy from Hacksaw Ridge. Coincidentally, he was a Christian, so go figure. But yeah, value of compound interest, avoiding get rich quick schemes, and patience in market cycles. Market's going to fluctuate. Market is going to fluctuate. Are you going to be in the market when that recovery happens? A contrarian approach. As prices are falling, what are you doing? You're building a position because markets are going to fluctuate. Market goes through cycles. And so understanding those market cycles is also a very important part of trading and finding success in trading and managing a portfolio and generating a profit in the market. So biblical wisdom for market psychology. What do we have here? Emotional control. This is what I said before. You have to separate yourself from the emotions and that value that you have, that you have to find a balance. Again, you understand the value of money, right? But you can't have that same perspective to money as society has ingrained you to have, because then you're going to be fearful. Because that's what society breeds. It's a fearful society, because that's essentially how control is maintained, through fear. Sure, it's all great to think that you can control the masses by having them love you, but we're not living in heaven at this point right here. We're living in this world, and the people at the top, they control people through fear. That's how it is. So you can't have that fear of losing a lot of money, because you have to understand, yes, it is money. This is a tool for one to survive in this world, but you can't be emotionally attached to it. Like, I don't want to lose it. As long as you're implementing proper risk management, the dollar of profits are going to increase. The dollar amount is also going to increase on the downside, on your unrealized gains and on your realized gains. Percentage perspective. You have to have a perspective about percentages rather than, oh, I'm up 20 grand. Okay, but you're up 20 grand and you're up maybe 2%, and the price hasn't rallied significantly to make that position high risk to continue holding. So yeah, you're up $20,000. Great, 2%. I invested maybe 10% of my portfolio or 5% of my portfolio into that position, I can continue holding, you know? Anyways, it's managing fear and greed. Managing fear and greed, super important, because Warren Buffett says, be greedy when others are fearful, hence a contrarian approach to investing, and be fearful when others are greedy. So when is the market telling you that you should be fearful? Well, when others are greedy, and when others are greedy, people are buying, and when people are buying, the stock prices are rallying all to all-time highs. You have to be fearful at that point. You're like, okay, this is eventually going to have to come down, right? But when the prices are falling, people are selling. And when people are selling, people are being fearful. And that's when you be greedy, because you're taking advantage of market fluctuations and market cycles. For example, the price of meat goes up 50%. Let's go 100%. Goes up 100%. You think there are going to be more buyers at 100% price increases of meat? No. Prices are going to have to eventually reach equilibrium where there's a balance between buyers and sellers, and people who are investing in meat. I mean, this is just an example, but people who are investing in meat and bought at all-time highs of meat prices, they're eventually going to lose money, because equilibrium, they're not going to be any more buyers to continue driving price higher at to a certain point. And then let's say price of meat goes down because of whatever reason. Maybe there's some fake news story saying that there's some disease in meats that are being sold in the grocery store when there really isn't. Prices of meat are going to go down because people are fearful to buy meat. And you call it BS and you're like, there's no disease. I work in the plant. I mean, that's a kind of form of a level of insider trading out there. But you could easily call it BS without being an insider and buy up all of the meat you can get. And when that price of meat goes back to equilibrium, where they're like, oh, no, there's no disease, people are going to start buying meat again, and that price is eventually going to reach fair value, equilibrium, and that's where you profit. It's going to reach fair value, or in other words, its true intrinsic value. Managing fear and greed, staying calm during market volatility is super important. This is where you, again, separate your emotions from what is happening in the market. And usually a lot of people get very emotional when there's an increase in volatility when there's an increase in volatility in the market. But volatility is what creates these price changes, and when the price changes happen, it creates opportunity for profit. So when I hear people saying, "Oh, there's a ton of volatility in the market, oh, my portfolio," okay, I could understand different perspectives there. When you hear people saying, "Oh, my I mean, there's different perspectives that you can look at it. But market volatility is how people extract profits in the market. You can't have profits in the market or losses in the market without volatility, without price change, right? So it's how you essentially deploy capital into those opportunities to be able to generate a profit sometime in the future. Staying calm during market volatility is super important. You have to look at it from a logical perspective, not an emotional perspective. Again, those dollar amounts are going to increase as you start allocating capital into the market and your portfolio is growing. But look at it from a percentage perspective. Community and counsel. Plans fail for lack of counsel. So this is mentioned in Proverbs chapter 15, verse 22. And the previous emotional control is, so whoever is slow to anger is better than the mighty. Proverbs 16:32. That is covered in Proverbs 16:32. Moving forward to community and counsel. Plans fail for lack of counsel. Proverbs 15, chapter 15, verse 22. So there's value in mentorship. So the Bible supports being guided by a mentor and learning from experienced investors and being part of an investment community in which you can engage with like-minded people, learn from people's mistakes, because I think Warren Buffett mentioned something about the best thing you can do is learn from the mistakes of others, because it's a very cheap way of saving yourself a very costly mistake. And so seeking that wisdom from people who have already walked the path that you want to walk is super important. And there's value in there. And the Bible clearly supports it. This wasn't planned, but if you want to join the link in the description, there's a free Discord community where I share my analysis and I post educational resources about trading, investing, technical analysis, fundamental analysis in an organized fashion inside of a community in which you can gain that information and also be a part of a community of like-minded individuals, which value can be exchanged. It's free. Go ahead and join. You have nothing to lose. So that's community and counsel. I think we're nearing the end of this video. Let's see, practical tips for getting started, setting up a strong foundation. You have to have an emergency fund. You have to have good debt management, starting small and consistent. Because starting small and consistent and being consistent, you're going to eventually take advantage of those compounding returns, and you are eventually going to be given more, especially if you're managing funds for other people. Investment vehicle options. You have index funds, individual stocks, ETFs, and retirement accounts. These are some things that you should consider. And then closing thoughts. So, reminder of stewardship responsibility, balancing profit motives with kingdom values, with values that God Himself has instructed us to comply with so that we can achieve life on this earth as to how He intended us to have life on this earth, right? He didn't intend for us to have suffering on this earth. So how can we achieve that life that He intended us to have on this earth? By following His instructions. I believe it says a fool despises instructions or reproof or something along those lines. So don't be a fool. Don't be a fool. Humble yourself and maybe consider that the Bible is something that is worth. If you're not a Christian, maybe if you stumbled across this video without being Christian and you're just, trying to find your path in life, maybe start with seeking God's kingdom and then let everything be added onto you. It's a Bible verse. Seek first the kingdom of God, and all things will be added onto you. Trust in not yourself, but in God. Have faith in His ways. Call to action for review and a prayer for wisdom in investing in decisions. I mean, if you want to say a prayer, you can say a prayer. I've never prayed on camera, so I kind of don't want to start now, but maybe sometime in the future. So excuse me for not doing that. But anyways, I hope you guys enjoyed this video. And if you have any questions, feel free to comment down below. Like this video if you found extreme value in it, and consider subscribing. I do plan on posting much more of these videos. This is a type of video that I enjoy making, and that is very valuable to viewers. So I appreciate your time, appreciate your viewership. God bless you, and have a good rest of your day. Bye-bye.